Now, what we are doing today is looking at this. I think this is the 5th unit that you're looking at starting, which is business ethics and corporate social responsibility. And this unit, is 20 credits. We are looking at this particular topic of business ethics and corporate social responsibility within the context of actually accounting, because these topics are quite vast. When we look at business ethics, ethics has lots of different definitions. We can look at ethics in our personal life when we talk about moral ethics, moral responsibilities. You can talk about ethics in the case of business organizations, various fields. But we are going to be concentrating on understanding business ethics from a point of view of financial and financial related information when we study or look at any business or organization. Similarly, in the case of corporate social responsibility, there is lots of areas which are covered under CSR, as we call it. So when we look at CSR, it's a very broad term. It has lots of meanings, and CSR can be studied from a context of studying it in the context of organization. But again, we are going to be focused on understanding the financial accounting perspectives of where corporate social responsibility is applied. So CSR, it could be things like sustainability, fair trade. It could be, looking at corporate governance. We also talk about CSR from a point of view of environmental, friendliness in terms of how businesses utilize raw material resources to produce goods. But here we are going to be focused on understanding the broad meaning of the term corporate social responsibility, but try and relate it to the financial side of things, because we are studying this unit within the diploma for accounting and business essentially. So in this unit, there are 3 learning outcomes. We are going to be looking at, first of all, in the first learning outcome, trying to overall understand the importance of business ethics. When did this come about? And when did the whole topic of business ethics became useful or started to come into the discussions of when we talk about organizational operations, business operations, things like that. And similarly, we will also relate CSR from a point of view of when this became important as a topic and how can we link it to financial decision making. That is the bit that we want to cover in the first learning outcome, which we'll focus on today. And then in the second one and the third one, we are going to understand the importance of corporate governance. So one of the aspects of corporate social responsibility is that companies need to run businesses ethically, and there should be some sort of a governance structure which should be present. So when we talk about, just briefly as an overview, when we talk about board of directors, we talk about management, we talk about senior management, and non-executive directors. These are people which basically look after corporate governance. But obviously, yes, within an organization, you have different people who will be responsible for running the governance side of the organization. So we will understand that and the ethical behavior which is expected of board of directors, chairman, non-executive directors, people at the senior end of the company, senior management or very senior people who basically look at managing and defining the operations of a company or a business. We will understand that in the learning outcome 2. And in learning outcome 3, basis the understanding that we have gathered from the concepts of CSR and corporate governance and business ethics, we have to actually put into practice some of these complex issues and show how organizations actually utilize them in their day-to-day running of the operations. So we'll be looking at reviewing the CSR principles, the structure, why this governance came into being. We'll look at some of the reports like the Turnbull report, the Cadbury report, the there is one report which is the Greenberry report, and they would inform us why these became important. And we'll relate it to the financial crisis of 2007-8, to try and understand the financial implications of why these are important from an organizational setting point of view. And then looking at with one of the case study that we need to pick out, We will look at making some recommendations in terms of why these financial shortcomings happen. And in order to overcome these financial shortcomings, what do organizations need to do when they follow the corporate governance CSR code, which has been set out under the regulation in the UK by OECD, in the European Union, in the US, and how it helps the companies to better manage and report their financial activities. So it's quite an interesting unit if you want to understand, how financial decision making takes place, within a company and within the remits of what is called the corporate social responsibility. Why are the directors accountable for the profits and the ethical operations of the business? And in some cases, we also want to find out, how much dividend, what shareholding, and how the transfer of the equity and other related instruments happens to the senior executives, members of the board, and also the employees in general. And all these are bound by laws which are under the corporate governance, under corporate social responsibility, and we need to be able to see that these companies are operating ethically from a point of view of running business as far as the operations of the company are concerned. So let's start off with a couple of things to build a bit of foundation in terms of understanding what is ethics, what is business ethics, what is corporate governance, what is corporate social responsibility. So let's look at some key terminology. Now, have you come across the term ethics? Have you come across this term ethics? Ritaj, have you come across this term ethics?
Sorry?
Have you come across this term ethics?
No.
Okay, so if you have basically the term ethics, means it is primarily, it means moral principles which can govern a person's behavior or when you conduct an activity. So an example of ethics would be that you would go to a shop and then you would not look at stealing from the shop. You would not look at doing shoplifting. So the ethics in that is that when you go to a shop as a consumer, what you're looking at doing is if you buy something from the shop, you're looking at paying for it, and that would be something which is going by your ethics. What is being taught to you as your upbringing or by your parents. So basically, you're going to stick to some morals and show or exhibit a behavior which is going to conform to some of the standards what the society expects. So when we talk about ethics, basically it is a science which is a science of philosophy or a branch of philosophy which involves understanding, defending, and recommending the right concepts and from the wrong behavior. That means, as given an opportunity, you would want to basically exhibit the correct behavior or the right behavior, and you would want to behave properly and follow some code of conduct, and that is what all will be a part and parcel of what is we call ethics. Now, when we add the word business to ethics, so business ethics would be basically things related to the organization, which will allow the organization to work ethically and offer their services in the market, whether it's product, goods, or services, whatever they are producing and they are selling to the consumer in the market. It will allow them to operate ethically. And when I say operate ethically, what I mean by that is the company will have a set of policies and procedures which it will follow, and these policies and procedures will allow it to work and offer these services ethically to the consumers in terms of offering its products and services as far as sale or exchange of those goods and services is concerned. So business ethics is quite important, and it is something which if I look at it from a point of view of the history, it became important in the 1960s when most organizations or corporations started to produce or mass produce goods and services, and they were then being sold to consumers in the market. So if you look at after World War II, lot of manufacturing and production, basically industrialization as we call it, started, and rebuilding of nations started. So when you see the mass industrialization happening after the 1940s, you would see that in 1960s, the most companies had started to, sell some of these products to consumers. When I say washing machines, refrigerators, you look at cars, a lot of these things were then affordable by consumers. And what they started to do was they started to look at essentially ensuring that in any sort of communication that they do, like advertising, most companies were using, things or messaging to be able to build a trust between consumer and, the let's say the organization which was looking at selling these products and services. So when we look at the history of ethics, ethics has started off, in the 1960s. And when we look at socially and ethically responsible organization, we look at this kind of a bit of a, like a timeline or a flowchart to say in the 1960s, there were issues which companies used to encounter, things like environmental issues, civil rights issues, things like honesty. And then in the 70s, it went into, working when the companies were looking at working more ethically. They were looking at, understanding what is discrimination, what is harassment at work, looking at employee rights. Then in the 80s and 90s, you look at bribery as an issue which started to crop up in developing countries. Deceptive advertising is one, wherein actually the message being conveyed is something different from what the product is being sold. You started to see financial fraud coming out, in the 80s, and there were issues in terms of transparency. That means some companies did not disclose their debt or, the finances properly in their balance sheet or financial statements. Now, this has been a bit of a gradual evolution of how ethics have changed, in terms of the importance within organizations. So this chart basically shows that in the 2000s, most companies were focused on employee benefits. They were looking at privacy issues like data protection. You look at in the Europe, we have now what is called the General Data Protection Regulation, GDPR. You look at financial mismanagement. When we look at some companies, fraud, and fraud-related activities happening or duping their consumers of the investment. When you look at stock markets, theft in terms of intellectual property. So some of these differences, in terms of when I say the meanings of ethics and what and how ethics have evolved over the years, as you can see within the corporate side of things, are also changing. So you see in the 60s, from environmental issues to looking at financial fraud and intellectual property, those kind of things have now started to come in as far as this is concerned. Now, before I get into the textbook definition of business ethics, let's look at a small video to understand how ethics and corporate social responsibilities are considered in the normal business activities of the organization. So let's listen into this small video, which will define what is business ethics, and within business ethics, why CSR is very important, from an organizational context or from a, business perspective.
Okay.
So this video will give us some idea in terms of, some bits of what we see happening in our day-to-day lives.
For many years, corporations were only concerned about making money. That was the ultimate goal. Now, companies are also concerned about society's welfare. Corporate social responsibility is a business's concern for society's welfare. This means that marketing managers are interested in long-term corporate interests and also society's health. A new philosophical trend in social responsibility is called sustainability. It is the thought that if a company helps society through their business as a main goal, then they will reach success. Companies can look to solve society's problems by creating a product or service to fulfill a need, and they will profit and help the world. Other examples of products made by companies that embrace this philosophy would be makeup creams made from ingredients that are imported from developing companies to help their country's growth. Another example would be ice cream maker Ben & Jerry's, who pride themselves in supporting charities. Ben & Jerry's has been donating a full 7.5% of pre-tax profits to different charitable institutions. Sustainability's forward thinking revolves around creating new products that in the long run will create improvement over time in society's skills. A current example would be a backpack designed with solar panels to charge electronic devices, or 100% biodegradable recycled cardboard coffins. Another way that companies can embrace social responsibility is through a different approach called Stakeholder Theory. This theory's central focus is that social responsibility is really giving attention to every stakeholder in the entire company, whether it be the employees, customers, owners, suppliers, management, or the community. The following is how each stakeholder would view social responsibility from their company. It is a more widespread approach and far-reaching. Employees want to have a good, secure job and excellent wages, while management wants happy workers and profits. Customers expect excellent customer service and high-quality products, while the community wants a corporation to pay their taxes, offer their citizens good wages, and help support the environment by not polluting. Suppliers want their business to remain plentiful, and owners, of course, want a financial return for an excellent profit. The most common reason against social responsibility is that critics feel the main purpose of a corporation is just to make a profit for their stakeholders. Nonprofits should be the only institutions concerned about society, not a for-profit business. Critics state that for most companies to participate in a socially responsible way, they need to spend more of their firm's money, and in the end are costing their shareholders a profit. For example, if a company is going to import ingredients from a developing nation instead of using a well-known source, then the added cost of...
So in this case, what you generally see is that when we talk about business ethics, the video basically gave us a clear example of, in what all areas you would see ethics being applied. One such area was that if developed countries, when they look at manufacturing of products, using the example of that cream, if they import the raw material from developing countries, which will allow them to grow economically and in turn, be beneficial for the society or people in that location. So when we look at different concepts of ethics, there are concepts like sustainability, environmental pollution. You look at carbon emissions, or as we say, carbon neutral. You look at fair trade. We also talk about, the negative effects of globalization. We will look at some of the issues which are related to water sustainability. How do we ensure that some of the manufacturing operations do not pollute, groundwater, which is required for our future generations. So when you talk about sustainability, we talk about oceans as well, the amount of plastic which is flowing into the ocean. So at some stage, when you look at companies like Coke and, Pepsi and some of the other companies which produce these fizzy drinks, they produce about 100 billion plastic bottles every year. And a lot of them, 400 million of them, actually end up into our rivers and then from our rivers into ocean. So when we look at projects like, where the companies are being asked to be ethically responsible for environment, to safeguard the environment, to decrease the amount of pollution which is going into our oceans, that is where the concept of business ethics, corporate social responsibility comes in. And under business ethics, there are lots of different connotations that we can look at, and they typically tend to be, we will cover them in subsequent slides, they come across in different variations, wherein a company would focus on saying that, okay, our corporate social responsibility, we want to make sure that the buying of the ingredients that we do from our suppliers is done in a way wherein it is fair for them to get a fair price, and that is called fair trade. So we look at different examples of looking at doing this, but let's broadly understand, the accepted definitions of business ethics. Now, when we look at business ethics, we look at it as a point of view of, a body or a framework of principles and standards which allow the company to work within a certain remit and produce goods and services which could be done in such a way that it is correct and right, and it helps in general everyone prosper, or does not harm the environment. But when we look at different other definitions of ethics, when we contextualize them, what we also see is, as per Walton, when he defines business ethics, he says it is concerned with truth and justice and has a variety of aspects such as expectations of society, fair competition, advertising, public relations, social responsibilities, and they are all taken into account when a company does, business. Then the other definition that we look at from Velasquez is that he talks about that this is something about a rule by which the individuals live their life, their personal or professional life, and when it comes to accounting, he says, or finances side of things, he says that companies need to look at working with certain ethics or code, and that ethics and code is primarily defined when we look at CIMA's code, the ACCA code, or the ICAW code. They have defined the codes of ethics for people working within the financial sector, whether you're an accountant, whether you're a taxation consultant, whether you're doing a VAT consultant. There is a code of conduct which has also been defined when people work within this particular profession. So in general, when we talk about ethics, we are basically talking about a branch of philosophy, which basically looks at differentiating right from wrong. It includes a set of moral principles which a person is expected to exhibit, and that basically tells us about the person's behavior while they're conducting a particular activity. And from a business perspective, when we look at business ethics, will have lots of different connotations, and they would be typically under the corporate social responsibility, and some of them is what we are going to look at in the assessment criteria 1.1. Now, this particular branch of, let's say, study is not new. And what we see is that generally organizations started to become aware of the subject of business ethics and corporate social responsibility way back in the 1960s. I'm sorry. And then over the years, over these decades, the context of how they are applied to business and business operations has been changing with the times. And today it is more focused on sustainability when we talk about organizations, environmental pollution, being carbon neutral, and also looking at, from a financial perspective, how companies are dealing, reporting, and providing their financial data so that it builds transparency and trust with its various stakeholders. Now let's look at getting into some of the assessment criteria that we talk about in this learning outcome. And the first one looks at explain the key principles of ethical behavior. So when we talk about ethical behavior and we talk about what does this mean, there are certain concepts that underline this particular principle from a point of view of a business or an organization. So these principles actually provide a bit of a foundation for how businesses, organizations actually work. And when we see people working within these organizations in order for the businesses to generate profit for its shareholders. Now, in doing so, what we feel is that when we talk about these basic principles, we are going to be looking at the business actually operating within some ethical boundaries. And these ethical boundaries tend to be built up on time, cost, and quality. And when we talk about these, what we essentially mean by that is the business should be looking into producing goods and services which are going to be responsibly using natural resources, and then also providing a greater good to the community in which these are sold. Now, when we talk about the basic fundamental principles of ethical behavior, we need to look at these principles from a point of view of, individual, business, and an organization. So when we talk about, the meanings of what does this mean for a business or an individual or an organization, sometimes you will see that we will classify ethics from a point of view of saying it is related to an individual. So when I say individual, business ethics, when it looks at individuals, is basically related to understanding the the person, how it behaves in the society. So behavior of a particular person, to a certain action, and also how they look at conducting themselves in the society would be behavior or ethics related to the person. But when we talk about a business, what we are looking at is the business essentially looks at establishing a relationship between the business itself and the customer. So here the idea is that the business is looking at creating a relationship which will allow the business to sell those products and services again and again to the consumer, and in doing so they are bringing across some of the practices which are also going to benefit the society. And when we talk about from a connotation of organization, what we mean by that is that when you work within an office or when you work within a company, what the employer needs to do is ensure that the company or the location that you work in is safe for work. They are able to provide you the basic deliverables which are required for you to work and deliver the output which is required of you in terms of your roles and responsibilities. And in doing so, towards the end, because you're working for somebody, towards the end of the month, like, you should be paid for the services that you have delivered. So as an organization, it is the duty to ensure that if the work is being done, a fair price or a wage, in some cases, if you're doing overtime, extra time, dividends, and other things are also being paid, so that it basically looks at the moral and ethical responsibility of the organization towards its worker. Now, something which I mentioned earlier in terms of where these principles will be applied. What are these 5 principles of when we talk about ethical behavior, or when we talk about business ethics in general? Now, these 5 fundamental principles, when we study business ethics, they come up again and again. So these 5 fundamental principles are integrity, objectivity, you have professional competence and due care, confidentiality, and professional behavior. So when you work within an organization, you're expected to follow certain rules and regulation. If the organization has a dress code, you're required to present yourself in that dress code. If they give you certain responsibility, for example, then you are representing the company when you go to meetings or seminars, then the company expects that you will behave in a certain manner which respects and protects the reputation of the organization. So similarly, when we talk about business ethics, we talk about these 5 fundamental principles which kind of define how the organization or individuals within the organizations actually need to conduct themselves. Now, when I talk about the concept of what business ethic means and CSR means, these are the various concepts that we need to look at from a company's or an organizational perspective. So when we talk about corporate social responsibility, we look at concepts like the triple bottom line, we look at fair trade, we look at globalization, we look at sustainability, corporate governance, you look at working as a social enterprise, which is slightly different from being a charity or a only for-profit organization. You look at cooperatives, and you also look at, nowadays, if you look at working within an organization, a lot of companies include in their employment contract what is called a psychological contract. That means the company will help promote a balance between work and personal life, so that you are able to deliver the roles and responsibilities required to be performing a job or being in a job, but at the same time you're able to spend time with your family and enjoy your personal life. So that is where you get to see this term work-life balance. So a lot of companies today emphasize on work-life balance, and this seems to be a bit of a psychological contract rather than a physical contract, wherein the organization expects that if you work between 9 to 5, then after that, if they get in touch with you, then they are encroaching on your family time or your personal life. And that is where most global organizations are actually looking at promoting well-being, which is not just physical but mental well-being, and ensuring that individuals have a balance between their work and personal life. And that would be called as what we call psychological contract. Now, there are certain principles that we also need to understand. This is a bit of a theoretical background that you need to understand when we talk about the ethics in general. We also talk about what is called the utilitarian principles of what generally is followed when we talk about business ethics. Now, utilitarian basically means, the word itself, if you know the definition, it means it is designed to be useful or practical rather than attractive. So when we talk about the principles of business ethics or corporate social responsibility, the principle of utilitarian benefits actually shows or basically talks about how these principles of business ethics can be useful and practical to an organization. So in this case, when we talk about these utilitarian benefits and principle, we basically mean this principle states that, actions that you take when you work within an organization have to be morally correct, and they have to be correct for greater, a number of people so that they are able to bring the greatest benefits. Sometimes an example of this would be if the organization is facing, say, for example, adverse conditions because of recession or loss of sale, and if the salary, if the company's managing director or the CEO takes a decision that we are not going to reduce staff, but we are going to take a cut in the salary. So in this case, as the CEO of the organization, if the CEO morally takes an action in order to not make sure that he's not making any staff redundant, then the action has to be done in such a way that it proves useful and beneficial for the greatest number of people, or as large as number of employees possible within the organization. Now, if he takes that decision for a period of 3 months, 4 months, and has to review it again, and he feels that pay cuts would not solve it and we have to let employees go, then what he has done by not taking an immediate decision is that he's made sure that he's taken a moral action wherein he has taken a pay cut at the CEO level, and all employees in the organization have been asked to look at that pay cut in order to save individuals from losing their jobs. Now, if he said that no, the senior manager is not going to take a pay cut, but only the middle managers are going to take a pay cut, or the staff at the front end would be taking a pay cut, then in that case, he's taking an action which is not going to be in greater good for a number of people, and he does not follow what is called the utilitarian principle. So when we look at ethics, there are 2 or 3 fundamental rules that we follow. One of them is utilitarian benefit. The other one is the golden rule. Now, this golden rule is actually found in the Bible, and it basically has been used by companies indirectly or directly, because what they try and do is when they try and solve an ethical problem, they try and place themselves in somebody else's shoes before they take a decision. So here the idea is that if the company or if an individual is to take a decision, they are going to basically first see how that decision would affect me if I was in somebody else's shoes, then take a decision on that aspect. So when we talk about people trying to solve problems, and by making decisions or taking decisions, they try and figure out what action would be the most fair action that they can take, which will be beneficial to them as well as to the organization. And the third principle that we look at generally being followed is the principle of justice. So in this case, when we talk about principle of justice, what we mean by that is that the decision makers here are actually guided by what is called fairness and equity. So when we talk about impartiality, the word impartiality, so in principle of justice, when decisions have to be made, they follow what is called impartiality. That means they will focus on equitable costs and benefits and of actions which are going to be distributed across the population or across the organization when it comes to employees. And this allows the individuals making those decisions to make sure that the decision being taken is going to be, again, good for the community in general. It is not going to be good for one person or a few people or a few employees in the organization. It is going to be a decision taken so that it is something which is going to be just and let's say good for the entire community. Now, when we talk about business ethics, these are 3 principles that you have to keep in mind: utilitarian principle of utilitarian benefits, principle of golden rule, and principle of justice. These are 3 principles that we understand broadly from a point of view of business ethics. And when we talk about the principles which are, fundamental principles of, when we talk about ethical behavior, then we talk about these which are integrity, objectivity, professional competence, confidentiality, and personal behavior. Now, let's look at applying these principles to the corporate social responsibility, because our task is to understand. If I look at task 1.1, it is to understand, after we know what are the key principles of ethical behavior, we need to be able to, and business ethics, we need to be able to apply those principles to corporate social responsibility. So when we talk about CSR, we are talking about, it is basically looking at analyzing economic, legal, moral, social, physical aspects of the environment. Because when we talk about CSR, we are talking about how organizations can be socially responsible towards their various, aspects of the environment. Now, businesses exist because they're trying to make profit, but in doing so, to make profits, they have to make profits legally. They have to make sure that the profits or the amount of profits they are making are done in a sense which is morally correct. They are socially justifiable, and they are also physical. That means they are also being protective of the physical environment from which they are utilizing natural resources to either produce goods or services which are being sold to consumers. And in this case, what we look at is, when we talk about the basic principles of CSR, the three basic principles that are related to organizations in general would be under the three categories, which is basically sustainability, accountability, and transparency. So when you are asked a question that what are the basic principles of CSR from an organizational perspective, you're going to be very confidently saying that there are three principles from an organizational perspective, and they are sustainability, accountability, and transparency. But if you're asked of business ethics and the principles related to, from an individual perspective, then you're going to talk about these five principles: that I have integrity. I look at things with objectivity. Before I engage, I understand what is right, what is wrong. I am professional in terms of delivering my work, so I follow ethical mode, and I'm considered a professional. I should bring a professional outlook to my job. You look at confidentiality, and sometimes you look at ethical or professional behavior. And when you talk about ethics in general, from a macro perspective, then you are going to talk about these three principles of utilitarian benefit, golden rule, and principles of justice. Is that okay? Any questions on this so far?
No, thank you.
Okay. Now, when we have understood principles, we also need to understand what are dimensions. Now, what is the difference between principle and dimension? Any idea? Do you know the meaning of the word dimension?
No.
Okay, so when we talk about, principle, when we say the word principle and, its meaning, what we mean by that is something which is fundamentally or, physically or morally true. It's a proposition because you're talking about it, let's say, in a generic sense. But when you talk about a dimension, what you're going to do is basically apply it to a particular situation. So when I say principles of CSR, you're going to generically talk about what does it mean, how does it help, why it is used. You're talking in general about what are the principles which make up corporate social responsibility, or what are the boundaries of corporate social responsibility. But when we talk about dimension of CSR, in dimension, what we are saying is measurability of how do you measure CSR, or how would we go about measuring the extent to which corporate social responsibility can be utilized or used within an organization, a business, from that perspective. So dimension is basically looking at, the physical word. When I say dimension, is you always think of, when you talk about dimension, things like length, area, breadth, width, height, those kind of things come to your mind. So when we talk about dimension, you're talking about measurability. When you talk about principle, you're talking about it in general as a concept, as an idea. So when we look at dimension here, what we are saying is, when we talk about the dimension of CSR, from a perspective of, say, one of the definitions of European Union is, they have defined CSR as a concept where corporations combine their environmental and social concerns with their operations in order to and collaborate on a voluntary basis with their stakeholders. That means a business which starts to run, produce goods and services as per the CSR definition would be that it is looking at using environmental resources, they are looking at the community concerns, and then the operations are conducted in such a way that they are able to take care of all the demands and requirements of stakeholders. Now, what will be stakeholders? Stakeholders are going to be customers, employees, workers, suppliers. The government can also be a stakeholder, banks. So what the company would need to do is make sure they are making profit, but the profit would be more, towards the CEO or the board of the company. But when I look at share capital, return on investment, that would be the stakeholder, which shareholder would be looking at that, okay, I have certain shares of this company at the end of the year. If they make this much profit, then what is the dividend they are going to declare? As an employee, as a stakeholder, what would be my main area of understanding is that at the end of the month, I should get my wages, right? And in some cases, when you look at employees from a perspective of, sales or other functions, they would see that, okay, if I perform quite well and I've exceeded my target, I should get a bonus. So when we look at dimensions of CSR, there are various ways companies would look at measuring how this is going to work for each of its stakeholder. And when we talk about these dimensions, we can talk about it in three different contexts. One is economic dimension, which is in terms of money, value, monetary value. Then we talk about social dimension, which is mostly to do with society, benefits which are being given to society, how does it help the society in general. And the third would be the environmental dimension. That means, is the company protective of environment? Is it disposing of its raw material, or the activities of that are not causing any damage to the environment? So sometimes you would see that companies, when they are processing something, for example, you look at the business of hides, leather or leather skins, and if the tanneries are basically using river water or sources of water to dry the hides or color the hides, then before they release the chemicals and other things into the river or into the stream, they have to ensure that they have made sure that it is not going to contaminate the water table or the rivers. And in those cases, the companies will be looking at the environmental dimension. Now, in terms of corporate social responsibility, this is a pyramid that we follow, which is like a very main framework that you need to know of when we talk about CSR. So there is a lot of work which has been done in this field. But when we look at Carroll's, CSR framework, he was the person who basically, came up with a pyramid or a model, which essentially is a framework that allows organizations, to basically argue or look at how they should look at meeting their social responsibilities. So he came up with a simple framework after a lot of research that allows if I have to apply this framework to an organization, I can pick up the Carroll's framework and it will allow me to argue whether the organization is meeting its social responsibilities or obligations or not. And there are 4 parts to this pyramid. So the key features of this pyramid basically look at that it is built on the fundamental understanding that the foundation, which businesses, when you launch a new company, you're very clear that you're starting a business because you want to make money, you want to make profits. But in some cases, when we look at the key features of this Carroll pyramid, what he suggested was that although companies are set up to make profits, but also they need to, comply with the laws and legislation or regulation in a particular geography. And before this is done, when I say before this is done, before a business starts to operate and starts to make profits and does it with following the laws and regulation, it should also ensure that it is meeting its ethical duties, which is towards society, environment, and he defined them into 4 of these parts in the pyramid. So the four parts of the pyramid were economic. That means the business is responsible. Yes, it needs to make profit. It needs to make it in such a way that the business can survive in the long term. But when we look at the legal aspects or the legislation and law side of things, he also defined that the business should be able to follow, and obey all the laws and legislation, which means that it could be related to employment law. Like in the UK, if you employ people, you need to be looking at paying them the basic minimum wage of £8.91. Now, if the business does not comply with this, then the employee can go and complain, and in this case, the company could be fined a lot of money because they are not complying with the laws. Similarly, he defined what is ethical, and that part of the pyramid in which he defined ethics, it basically meant that the businesses and the individuals which work to produce these goods and services should act morally and ethically. They should have a responsibility to follow the law, abide by the law, and uphold the law. And the ethical side of things also means that the people in the business need to be treating its customers, whether it's indirect customers, suppliers, partners, employees, in a very moral and justifiable manner. One of the last things which he defined in this pyramid was philanthropic. That means there is a responsibility the business has to give back to the society. And this responsibility is discretionary, but it is very important. And in this case, you would see in the video that we initially played, you saw that Ben & Jerry actually donates 7.5% of its pre-tax profit to charitable organizations. And this is a way to show that they are, looking at implementing one of the aspects of, the Carroll's pyramid, which is the philanthropic side of things, that the company is seen to be giving back to the society. And in this case, they are contributing 7.5% from their profits to the building of society in terms of, whatever, be it by giving or donating money to the charity. Is that okay? So Carroll's pyramid of CSR is one of the main models that you need to be aware of when we talk about corporate social responsibility. Okay. Now, there are lots of different ways we can apply CSR to different facets of working within the organization. One such thing that we can look at is when corporate social responsibility is applied to managing the company from a point of view of its management and also from a point of view of its leadership. So when we talk about ethical management and leadership, we can apply the principles of CSR to that as well. And in this case, this is a table which basically shows that sometimes types of management can be immoral management, amoral management, and moral management. And they can also be contextualized from a point of view of corporate social responsibility. Now, there are a few slides which I put in, and they primarily help understand, in detail, the various things which are related to the, say, for example, the overall study of ethical behavior and why CSR needs to be followed within organization. Now, one such aspect that I've discussed is globalization, which is addressing its negative effect. Now, we all know that globalization is useful, and obviously, it is something which a lot of companies today are experiencing in terms of growth into new markets, and globalization in general is bringing prosperity, uplifting population from poverty levels, and this is in general good for the society. But there are lots of negative benefits of globalization as well. And these negative benefits of globalization can be seen when companies actually look at becoming greedy. They start increasing the scale of their operations without having to, without worrying about what are the detrimental effects which its operations are having for the environment in general. And what we see as a negative effect of globalization is when you see these greenhouse gases increasing, when we see the temperature rising, water levels rising. So this is one such negative effect of globalization, because environmentalists actually feel that it is leading to more global warming. It is leading to the melting of glaciers, and in general rise of the ocean levels, which is going to threaten the population or the people living, just over the sea level or in islands in and across, various places globally. So one of the outcomes of, let's say negative outcomes of what we see CSR is that globalization can be seen in a context wherein how it can be termed as negative when it comes to corporate social responsibility. Now, one of the other bits that we also need to understand when we talk about CSR is Elkington's triple bottom line. Now, this particular concept, when we talk about, is going to be TBL as we call it. And this particular concept, will basically come across a number of times that you will get to hear about this when we talk about the triple bottom line concept. Now, this is a particular model which was proposed by Elkington. And the model, the reason why he proposed this particular model was that he wanted to showcase that how corporate social responsibility can be incorporated into an organization's agenda, and how can organizations be held accountable when they look at this, the responsibility towards people, profit, and planet. So the triple bottom line concept actually encourages the company to assess the overall performance of the business, but through the three important areas in terms of how much profit is it making, how is it benefiting people, and how does it benefit the planet. So in this case, when we talk about this concept, it encourages businesses to overall, study their performance from the prospect of understanding and analyzing how this has been profitable for its people or beneficial for its people, what kind of profits the company is actually generating, and last but not the least, how is it benefiting or what kind of effect is it having on the planet. And in doing so, John Elkington basically, also argued with the approach of balanced scorecard. Have you heard about balanced scorecard? Raj, have you heard about the balanced scorecard?
No. Well, this is the first time that I see a text, so that's what.
Okay,
Right.
balanced scorecard, is one of the important, tools, which is basically, proposed by Robert Norton, in the early 1950s, 1960s. And the concept of the
Yes.
yeah, you heard about it, yeah? The concept of the balanced scorecard is that it takes into account the four basic elements of how the organization actually functions. So it takes into account the financial side, the customer, the internal processes, and what is the learning and growth which can happen for employees in the organization. So when we talk about, the triple bottom line concept, similarly, what John Elkington actually proposed is that when organizations look at overall, studying the performance of the organization from three aspects, it needs to take into this account that, how much profit is it making, how is it beneficial to its people or its employees and society in general, partners, suppliers, and last but not the least, is it going to be, how is it going to be effective and useful for the planet. So he defined profit, which is what most companies look at making, but he also identified that, sometimes the companies need to look at their profit and loss, and this profit and loss has to be looked at from a point of view of understanding whether, are they making enough profits to be able to pay and, look at look at pleasing their stakeholders. And similarly, when we look at planet, it talks about the impact of business activity on the environment, whether the business is having a negative impact, whether it's leading to pollution or is it leading to land pollution, what kind of an impact it is having on the land, that means on the planet. And when you talk about people, does it provide job opportunities, does it create job opportunities, does it pay fairly, that means does the organizations pay its employees on time, and those are the things which are part and parcel of the triple bottom line concept. So there are some advantages and there are some disadvantages. but this is another important framework that you need to be aware of when we talk about CSR in general, corporate social responsibility. So when companies are audited, when companies are held accountable, when people look at evaluating companies' performance, they can actually put it in parallel to the triple bottom line concept and see that how are the operations of the company beneficial for the planet, how are they beneficial to the employees, how they are beneficial for its stakeholders when it comes to looking at profit, return on investment, and things like share capital from a long-term perspective for the company to survive. Now, one of the other bits that we look at in terms of corporate social responsibility is sustainable development. So sustainable as a term, it means enduring, lasting, or to keep it going for as long as possible. Sometimes you make this statement that I bought this particular machine, or I bought this particular item and it's been going for years. I don't have the need to replace it. Now, when you make that statement, what you're basically saying about is that the product that I bought, say maybe a washing machine that you bought, it's so well built, its quality is so good that it's been going for a number of years and I've had no problem for it. And that means that you do not have a need to replace that, which would mean in turn that the environment is also protected, because the same machine that you bought has been used for a number of years and it's still working and you're happy with it, rather than go across and upgrade it or change it. So when we talk in general about sustainable development, what we are talking about is that most companies are looking at using resources in such a way that it does not damage the environment. Now, the reason why sustainable development and as a concept it came across was there was this person who basically started talking about why companies need to look at this as a concept. And when David Pierce actually talked about it, he said sustainable development means that each generation should pass on at least as much capital as it inherits, and this approach, defines, in general, in broader terms, the physical capital, the intellectual capital, and the environmental capital, which we will pass on to our kids in the next generation. So what he meant there was that we should make sure that whatever we do in terms of activity should be done in such a way that we are not able to just make benefits for ourselves in the present time, but also transfer over, the natural resources and the environment in such a way that it is also going to be beneficial for our future generations. And in this case, the Bruntland Commission, on the environment and development, basically came about. This is a report which you will normally hear about and come across a number of times when we talk about sustainable development. And this approach was adopted by, once it was produced by the Bruntland Commission, and is now a part and parcel of large companies which use natural resources to produce goods and services. So when you talk about Tesco's, when you talk about Starbucks, when you talk about companies which use environmental raw material or resources, they have to follow the concept of SD, or sustainable development. And in doing so, to produce goods and services, they need to ensure that the development meets the needs of present without compromising the ability of future generations to meet their own needs. So you have a responsibility to preserve the environment, to preserve the oceans, preserve the natural resources, and that is in a sense what the concept of sustainable development is. Now, in the UK context, obviously the UK government has adopted this concept of sustainable development, and it has basically made it mandatory for companies to follow this particular code, which is defined for certain companies in terms of where the operations require the use of natural resources. Now, the bits that I'm discussing in this particular slide are basically being elaborated from here. So the modern concept of ethical operations of the organization are related to these concepts that I'm talking about. Triple bottom line, ethical management and leadership. We'll talk about fair trade, globalization, negative effects, sustainability, we're going to go and look at corporate governance, social enterprise, all these. So I put together one slide each to explain this particular, concept, so that we know that when we talk about CSR and we talk about business ethics, what does it mean to, from an organizational or a business perspective? Now, you cannot have one organization looking at everything: CSR, sustainability, fair trade, globalization, negative effects, everything. Because sometimes the operations of the business would be different, and in those cases, we would have to apply a specific aspect of CSR to the company. Now, when we look at UK Versity, and if I have to apply CSR within that, now in our case, we wouldn't be able to apply some of the things like, triple bottom line concept, because we are not using any environmental resources. We will not apply fair trade because we are not physically producing any goods. We are not looking at sustainability because we are not in the process of building or manufacturing anything. But yes, when we talk about, reporting our finances, when we publish our financial accounts, we need to follow good examples of corporate governance. When we talk about leadership and management, yes, the leadership and management in the company should, promote ethical practices, which would mean that employees get their wages on time, they are treated fairly. If there is a dismissal or a redundancy process, it is done through a particular defined process, and nobody, when we talk about, employees or staff, are, meted with a wrong end of the stick. But some of the other bits might not be applicable. So similarly, when you apply, the ethical side of things within organization, sometimes you would see some of these concepts would be applicable, not all. And that's why the idea is to try and understand each of these with one or two slides. Now, when we talk about corporate governance, what is corporate governance? It's a set of rules, practices, policies, procedures, which are, created in order for the company to be run and directed by or managed by the directors or the boards of the organization. And these are basically nothing but rules or frameworks which allow the company to achieve its objective, because here the company would follow a policy. Like if the company has an employee handbook, an employee handbook is given to all the new employees which join the organization. The rules and regulations, the conduct side of things are all defined in that. And what the organization expects is that when you work within the company, you follow the guidelines which are given in the employee handbook. You cannot, if it says the dress code is suit and tie for males, and if it says a smart, casual, or a formal dress up for females, then it is expected that when you come and work for the company or when you come to the office, you're dressed appropriately, and that is what allows the company to set rules, regulation by which it can run its day-to-day operations. Now, when we talk about corporate governance, we also talk about areas which are included in the corporate governance, which include things like ethical behavior, compensation, talent management, risk management, health and safety. And these are basic things which companies have to follow through in order to ensure that the employees working in that company's location, offices, feel safe, and they are able to be productive and able to do their work, following some of the guidelines which have been provided. Now, an example of corporate governance would be, I don't know whether you remember the episode which Volkswagen as a company has undergone in the last couple of years, is when they had this issue of, companies, engineering teams not reporting the right, emission standards for diesel cars. And obviously it was called, the whole issue was called Dieselgate. The company's management, was made to resign. The company then had to look at recalling, a lot of cars in which, these manipulations were done. And this led to the company, declaring a loss for a couple of years and having to set aside money to be able to do and deal with this particular issue of, how the cars were actually sold, but the engines were essentially, rigged in terms of the emission equipment, which meant that the cars were giving positive pollution tests, whereas they were actually polluting more with regards to the standards set by the environmental, organizations in Europe, America, and other places. So when this thing happened, this was a bad example of corporate governance, because there were not enough checks done by the senior management in the organization to ensure that the company is following ethical guidelines, and this kind of practice should have been avoided. And this is an example of how corporate governance, which is the documented policies, procedures, and rules and framework, allow the management of the company to run the organization and to hold the employees and the organizational perspectives accountable. Now, we talk about social enterprise. There are a couple which I've included, which you can also go through at your own pace, because they explain this from an aspect of different ways in which we can apply CSR to different organizations. So I put across one slide each, and you could pick out any one of this example to complete your task 1.1, wherein it basically asks you to talk about the key principles of ethical behavior. So when you talk about the key principles of ethical behavior, you're going to be talking about the principles which are related to individual businesses and organization, which is this, and the three principles, which is the utilitarian benefit, the golden rule, and the principle of justice. And because it talks about CSR, so you have to pick out any one from this slide to explain and complete this task. So the three principles, you might choose globalization, negative effect, you might choose social enterprise, you might choose corporate governance, and that would be covering your task 1.1. Is that clear?
Okay.
Okay. Now let's go to the second assessment criteria, which basically talks about how to evaluate business ethics and the link between CSR and financial decision making. Now, let's not forget, as I mentioned initially, that we are studying this unit in the accounting and business discipline, because what we want to do is apply the concept of CSR and business ethics to the financial side of things within a business. So here, when we talk about ethical decision making, which is used in finance, is primarily a clear philosophy of defining what is right and what is wrong. So as an accountant, if I have to create records for a company, I know the moral codes of working as an accountant. I know the professional code which is there, and I need to make sure that if there are things which are not correct, I need to report them. If there are things which are say for example not meeting the standards which are required to produce and publish these financial reports, then I need to inform the owners, and so that they can make appropriate changes or take actions to correct that particular thing. So when we talk about ethical decision making in terms of financial side of things, we are looking at talking about compliance. There is in general compliance which has to be managed by accountants, by VAT consultants, by tax advisors, anybody who's dealing with any sort of financial instrument, whether it's a loan or a mortgage or a company's account. You're looking at dealing with securities, shares. What you're looking at doing is, as a person operating within that field or looking at that from a point of view of finances, if you manage it, you're responsible for it. What you have to ensure is that you're following compliance essentially to make sure that there are no violations of law, and to a certain extent you are actually reporting anything which is not meeting this criteria, in order to ensure that malpractices are picked up, and reportings of over profit and let's say misappropriations are reported to relevant authorities. Now we will look at understanding this from a point of view of, because it talks about evaluation. So what we need to do in order to evaluate, what I'm saying is that this task is asking you to evaluate. So when we look at evaluation, how would you do evaluation? You have to talk about the basic context of what all is being asked for in detail, and then we have to make a judgment whether this information we provided is going to be sufficient for financial decision making or not. So when I say evaluation, what we need to talk about first is business ethic. We have to talk about CSR, and then we have to talk about the link of business ethics and CSR to financial decision making. And how will we do this? By putting forward arguments or basically putting forward, information which allows us to understand the context of financial decision making when it is done within an organization. So when we look at certain aspects of this to talk in detail, what we need to understand is that what do ethical decision making means in the financial context. So when I talk about ethical decision making, what could be the reasons why you see these, scandals or frauds happening? Now, one of the reasons why this happens is that sometimes you would see organizations would breach the legal standards or violate these standards which have been set in the case of accounting and financial reporting. And this is done through the route of mismanagement of funds. They produce biased reports about financial forecasting, saying that the business of the company, like you look at Bitcoin, it was in the news in the last couple of weeks. And Elon Musk, who's the owner and founder of Tesla and SpaceX, he invested heavily into Bitcoin. So once he invested, what we saw is that the share value of Bitcoin jumped 400%. Now, this, if it is used as a forecast by the company to say that the company would continue to see this rise in its share and market value at 400%, and would then give out some predictions about how the company would look like in terms of its finances and its financial position, say in 2022 or 2023, would be misappropriation or misrepresentation, because one investor investing into the company will always not lead to a rise of 400% in its share price. And as we can see in the last few weeks, the share price has also fallen by 50% because there was a lot of hype around the investment which Elon Musk had done in Bitcoin. Sometimes we look at insider trading. You know what is insider trading? Any idea in terms of what is insider trading? People who are within the company are aware of and privy to confidential information. If they use that information to make financial gains for personal or for reasons, which is because for personal reasons, then in that case it will call insider trading. An example of this would be when that the company is going to float its shares or is going to do initial public offering, and we know that what will be the opening price at which it will list itself on the stock exchange, and you then go about as an employee buying more shares or asking for more shares to be given to you, would lead to insider trading. Another example of that would be that if you know the results of the company this year have not been good in terms of its performance, and you have hold a number of shares, and you know that the results when it is declared, the share price would fall. So what you do is because you are privy to this information, you sell the shares that you hold in the market, and that would be an example of insider trading, because you are doing something as an employee because you have access to the information and doing something which is going to benefit you because of that confidential information that you have. So when we look at financial decision making and a link between CSR and business ethics, these are some of the reasons why we see the links being established. Overt fraud, excessive compensation programs, stock options being given to senior management. Now, stock options, when it is given to management, you would generally see that they have the option to divest or sell those shares after 3-year, 4-year period. But it's a way of company actually giving a lot of compensation in terms of stock option plan to a senior member in the company, which is very disproportionate to the pay rise. Now, if you are, say, for example, Steve Jobs in the company and in Apple, and you get 60 million shares, but those 60 million shares are going to be awarded to you over a period of 5 years' time, provided the company hits these goals. But as you know, the share price of Apple is $1,800 per share. Then in this case, if you multiply 60 million by $1,800 per share, the chief executive is actually receiving a windfall of in excess of $480 million, which is a very high rise in terms of salary or package or compensation being provided. Now, if you were working within a company and you are a CEO, even if the company is doing very well and company's employees and the company board sanctions a bonus for you, you might get 5, 6, 10% salary rise. You might get a bonus of 10 million, 20 million, but you'll not get a bonus of 480 million, just because you're a chief executive. So here, when we look at the link between CSR and business ethics and financial decision making, sometimes you see that companies award lot of compensation or excessive compensation through the stock option plan to its senior management. This could include kickbacks. This could be other forms of financial gains which are provided to employees or staffs or members of staff or partners and suppliers, which would be related to or seen as what is called unethical behavior. So in the subsequent slides, what I've done is just to explain each of this, I have put together one of the slides. Now, sometimes you would see that when we talk about ethical misconduct from a financial perspective within an organization, you would generally see that what happens is when a business conducts the business through the ethical and moral means by following the good judgment principle or the utilitarian method or the principle, you would see that it benefits everybody, all employees, all suppliers, partners, society, everybody in general. But when you see that as a business, you have over-reported your profits or under-reported, your receivables, and at the end of the day, what happens is that the company gets into financial difficulties, and then the enforcement of the law has to happen, or the accountants actually declare that this was a wrong practice or this was done. Then in those cases, what is happening is that the company did not upfront declare this problem. This was found out after an investigation or after an enforcement was done, and that is why these steps would be called reactive rather than proactive. So in some cases, when you see these kind of breaches which happen in financial decision making or in finances of the company, whether it's over-reporting of profit, I think a couple of years back we saw the over-reporting of profits happening at Tesco, wherein Tesco reported profits. The financial directors of the company actually bloated the cost of inventory and over-reported the profits in the balance sheet to the tune of £3.7 billion. And that led to a large corporate fraud, for which the Financial Conduct Authority also fined Tesco some 320 or 350 million pounds because they did something which was not, let's say they did a fraud essentially. And that fraud was over-reporting of inventory, which led to over-reporting of profits in the balance sheet, which were actually not there. So in this case, when the fraud has happened and it has been detected and reported, this then becomes what is called reactive enforcement. Because if this was discovered before this was published, then no such fraud would have happened. But because it has happened and then the sequence of events have happened, it will be called as reactive rather than proactive. Now, there are lots of examples of these financial scandals which happen, and that is why business ethics and CSR have become a part and parcel of the company's code of working. So when we look at the WorldCom financial fraud which happened, you look at Arthur Andersen, which was the firm which were the auditors of WorldCom's reporting of financial data. They were actually held accountable that they were the ones which were not able to detect this, that the company was looking at removing the 3.8 billion pounds worth of expenses from the income statement because they were to be depreciated over time, and this allowed the company to show excessive profits. And in this case, again, as you can see, there was a collusion between the accounting or the auditing firm and the company, and this is what will be called an overt scandal or an overt fraud, and that is what is an example using the company WorldCom. Now, I've done a slide which basically shows the number of scandals or frauds which have happened over the last 10 years between 1998 and 2008. And you would see that this has led to loss of public money. This has led to some business closures. This has led to a lot of job losses, and a lot of investors or people have lost their savings when these scandals were discovered. So when you look at the financial crisis of 2007 and 8, what we also get to see that these were some of the reasons why you see that CSR and the link between business ethics and CSR was established by a lot of government organizations worldwide, and there were lots of laws and other things brought into place because we see this financial fraud happening within the corporate sector, and that is where it needs to be regulated and monitored. And there are lots of different laws which have been introduced over the years in order to restrict these scandals and frauds to happen. Now, one such that you need to be aware of is Sarbanes-Oxley Act, SOX as it is called. Now, this was introduced way back in 2002 after some of the scandals which started to happen in the corporate history in the US. And some of these big scandals which started to happen with Lucent Technologies, Halliburton, in example, Computer Associates, CA, these companies actually, lost a lot of money for its shareholders. A lot of employees lost their jobs and things like that. And the US government came out with what is called the Sarbanes-Oxley Act, or SOX, in 2002. And this was something which was introduced as an act to, let's say, restrict the number of corporate frauds that could happen by introducing a regulation which allowed, companies to follow this and incorporate it in their day-to-day working. So this legislation, when it was introduced, it made it, mandatory for organizations to go through an audit and disclosure procedure in order to publish their accounts in the US. And if the companies did not disclose any of the financial shortcomings or did not get their accounts audited before publishing, then these companies could be fined or given penalties in order to ensure that this corporate fraud does not happen. And this was done as a proactive approach. So we had a reactive approach in which what happens is that the company's financial mishandling is actually detected, but by the time it is detected, what tends to happen is you can only do course correction, but most of the fraud or the miscalculation in terms of reporting of finances has already taken place. But with the introduction of the SOX Act of 2002, it made it mandatory for companies to disclose voluntarily any financial shortcomings before they publish their financial accounts or their statements. Now, this has a repercussion, or there were similar laws which were introduced in European context and in UK as well. But this one is important for you to understand because this was the beginnings of the first legislation which was introduced in order to minimize, any fraud or financial miscalculations which the companies or organizations reported. And that is where we get to see the beginnings of the linkage between CSR and business ethics being done in order to relate it to financial decision making for the organizations. Is that okay? Is that understood?
Yes.
So why do we understand, or why do we study SOX? Is because when a lot of corporate scandals started to happen in the US between the 1998 to 2008, the government initially introduced this act or a legislation so that the companies could disclose voluntarily any financial irregularities before the accounts were published. And this made it mandatory that the organizations had to report it, otherwise they could have faced stiff penalties. And because of this particular practice, companies and organizations started to draw a link between corporate social responsibility in terms of making ethical profits, reporting of ethical profits, and business ethics or in terms of workings of the organization. Okay. Now, when we talk about ethical decisions, and when we talk about financial implications of these decisions, what we do is we need to explain it in the context that when we see companies looking at making excessive profits, and these excessive profits actually look at using environmental resources and they are not benefiting the community, then in those cases, this has an impact on the financial decision making of the organization. And this is what I've summarized in terms of this paragraph that you see in terms of task 2.2. So this is the conclusion that I've summarized, that when we look at financial decision making, why is it important to draw a link between CSR and business ethics? Any questions on this so far, Ritaj?
No, it's clear.
So it's a bit of a long discussion today in terms of presentation, because learning outcome 1 actually helps us understand and set the tone to study, ethics and also corporate social responsibility. These are two different units. So what I've tried to do is in the first learning outcome, try and cover the basic concepts of business ethics, basic concepts of CSR, and then relate it to the indicative content, which OTHM has actually, given for learning outcome 1. Technically, these are supposed to be 2 units. If you study them in a university or otherwise, I think they will be 2 different units. One is business ethics, like in ATHE we teach that. So this is a different unit. ATHE has business ethics, and there's a separate unit which is called corporate social responsibility. But here in the case of OTHM, what they've done is they've merged it into 1 unit, and that is why some part of the content that I have to cover in order to do justice so that you are able to understand this well, has been done from a context of covering some of the bits in a bit more detail. Is that okay?
Yes, okay.
So the presentation slides are also detailed. As you can see, this part of the unit is a separate unit, business ethics. We just study ethics and these side of theories, the Carroll's framework, triple bottom line. This is a separate unit. And then I have a separate unit called corporate social responsibility, which also, basically has been merged. So some part of the content what OTHM has done is brought in from ethics, and some part of the context they have brought in from what is called the corporate social responsibility. So I hope this part of the presentation allows you to understand the topics from a macro perspective. So as you can see, this is a second unit, which is totally different. Sustainability, regulatory framework. We talked about the dimension like economic, environmental, and social. So this is, a different unit altogether. But how they brought it together, is a bit of a mystery. So
Yes.
that is why there's a lot of content to cover in the first learning outcome.
Okay.
Okay, so if you have any questions on this, do let me know, and what we will do is discuss them, and I can send you some additional information, because there are some handouts which I'm going to upload on the Moodle, which are going to be useful for you to just study, and also maybe understand some of these in a bit more detail. And these are going to be articles. So one of them is this, which is hopefully going to be helpful for your assignment when you do, which is the study of relationship between CSR and financial performance.
Okay.
Which is task 1.2 in general. Is that okay? And then there is another one which I'm going to upload, which is going to be related to the fundamental principles of ethical behavior, which is task 1.1. So this one is a bit of a report which has been done, and that gives you a bit of an idea in terms of why ethical behavior became a part and parcel of the business operations or organizations in general. So these 2 topics are articles which have been published, and they will be useful for task 1.1 and for task 1.2. So if you look at some of the principles here, like the utilitarian benefit, the golden rule, the principle of justice, this is what I've taken from this particular article, because it will give you some background and understanding about business ethics in general. Okay?
Okay.
Good stuff. So let me end this session for today.